If you save £4,000 a year on your tax
Right.
at retirement, it gives you an extra £1 million. We ended up saving him 9 times the cost of the tax plan.
9 times?
9 times. They think that their business is going to be worth millions, and that's going to be their retirement, and it isn't. So for a lot of business owners, they're just looking for the cheapest accountant because they look at accounting as a compliance box.
Saul Cohen, founder of ExpertEye and one of the UK's most experienced acquisition advisors. Welcome to the show. Saul started his career at PwC, being involved with 150 acquisitions, and he's not even 35 yet, which is ridiculous, right? When do you know it's time to change accountants?
Tax is the point where it's time to leave your accountant.
How do accountants calculate valuations?
finger in the air.
Don't tell me it's guesswork. Stop it. What's the biggest mistakes you see people making when they think, oh, it's time to sell the business?
They wait too long. Well, it's a minimum 18 months to sell a business.
Yeah. So you've got this framework called SCORE. Is that
basically the culmination of my 150 acquisitions? The last one, exposure or risk, will absolutely cap your multiple.
Share the story about how you had to downplay the results.
All the ads were, say, £40,000 a year. And what we found was that no one was kicking the ads.
Hi, welcome to this edition of the Grown Up Business Podcast with me, Paul Avins. If you are an entrepreneur who wants to understand finance and numbers, but also wants to know how in the world do you scale using acquisitions, you are in for a treat today. This podcast is the place to be because we are going to take a deep dive into the whole world of acquisitions with our amazing guest today who has, and I kid you not, been involved with 150 acquisitions, and he's not even 35 yet, which is ridiculous, right? So I'm so excited to welcome to today's show Saul Cohen, founder of ExpertEye and one of the UK's most experienced acquisition advisors. Welcome to the show. Saul started his career at PwC, which is incredible, right? And he's done 150 acquisitions. It really sort of, you specialize in businesses between 1 and 5 million, that kind of space.
Yeah, like 8, but sub-audit. Yeah.
Sub-audit level, which is 10 million for those who don't know. And really kind of, you've got tons of lessons, I'm sure, about what to do and what not to do, which we'll get into in the show. You also sold your first business before getting involved in the corporate world, which I think is a really interesting journey we should unpack as well. And we've known each other for 4 years, I reckon.
Yeah, 5 years.
4 or 5 years, because you've been in one of my F12 mastermind for that length of time. And I have to say, really interesting to see your growth and journey as an entrepreneur and CEO over that time as well. And we'll talk about some of that as well. So welcome to the show.
Thank you so much. Yeah.
So here's the thing. Have you always had a fascination with numbers? Has that always been your thing?
Yes, because I was good at it. And I think it is that way around. It was algebra that I was really good at.
Right.
And thinking about it now, I was good with arithmetic because I just picked that up quickly. I'm dyslexic. So
welcome to the club.
Yes. Numbers,
we have a shirt.
Numbers always spoke to me. And I was more naturally drifted that way. In hindsight, I realize that now, actually, algebra is probably the more creative side of maths.
Right.
And I think people who are a little bit more creative are better at algebra.
Right.
And I think that's part of the reason that I picked that up quickly. And I was just drawn in that direction.
That direction. So what was the first business that you set up then? What were you doing? Because I was saying just before we came on camera, I've known you 4 years, and I don't think I don't know much about that. So what was that, and then why did you sell it, and what were let's talk about some of that.
Okay, so it's a funny thing. When I was at school, all my friends they used to get annoyed at me. They'd be like, "Stop using your Jedi mind tricks." They got really frustrating. I think I was just naturally good at persuading people to do things.
Right.
And that was what it was, and it led on from there. I was always thinking about, okay, well, what business can we do? How can we make some money? And I was creative. I liked building. I liked creating things, and we always came up with loads of ideas. And the one that, by the time I got to uni, I was really frustrated.
Right.
I was frustrated with the fact that I'd just been in education for so long. I'd never taken a break. I was really bored of it, actually, at that time.
Right.
And I just wanted to do something. I wanted to create some kind of value in the world. I wanted to make a change. And so I thought what would be really cool is I'm good at maths. Let's go tutor.
And travel, was that like a tutor and travel thing, or?
No. It was actually at the time. It was I could probably tutor kids who need help.
Right.
Like just kids who need help.
Yeah.
I'd be less expensive than a qualified teacher because I'm a student.
True.
And that'd be really good value. And I did that and was fairly successful at it. And then I thought, well, do you know what would be really cool is if we can get other people to tutor, and then I don't actually need to tutor. And then I thought, well, do you know what would be really cool is if we set up this online platform and we tutored across the world, and we could, and we got overly creative with it. And the aim actually was, could we find a way to provide cheap education in the developing world?
Oh, wow.
And also give students an income.
Right.
Because I thought that'd be really cool.
So you're trying to have an impact and generate income at the same time?
Yes. And we tried it. It did all right. We built a nice website. It had a good database. It was very strong back end. When I went to PwC, I had to sell it. It never really reached the heights that I thought it might. And this is quite a cool one to know, actually. So there was a competitor who launched doing a similar thing without the social, let's go and build a platform in the third world. And he sold his business when I left PwC for 14 million.
Wow.
Yes. And I did not sell for 14 million.
Okay.
Yeah, we sold for a lot less than that. And I think that was one of the great reminders for me that the value is not in the idea, it's in the execution.
Yeah.
And as someone who naturally comes up with loads of ideas and thinks they're great, I think that is a really important lesson to remind myself of. Yeah.
I think it's, wow, what an insight. I think what's interesting is that I've always said that the universe gives the same idea to about half a dozen people at roughly the same time, right? In some way, shape or form. Or half a dozen entrepreneurs all see the opportunity or the window. And I think the difference is, like you say, who executes and who executes consistently and fast enough, right?
Yeah.
And I'd also say that you were probably right ahead of your time as well, because when was that? When were you doing this? Must be, what, 10 years ago maybe?
Oh, it was long. Yeah, it was about 2010. Yeah,
right.
It was about 15.
So you think how far the online education market grew after that, and then, you know, when COVID hit and all those things, it's like it blew up. You were just probably a little bit earlier as well.
Yes.
But it's interesting that you were in the same market that someone then exited for 14 million, which...
Well, actually more, because in COVID, as you say, there was I had a friend of mine who was working in a private equity that was wrapping up schools, global schools, and they acquired an online school platform for 80 million. So, do you know what I mean? The opportunities really were endless. It's the same business. It's just, the execution, delivery, and timing as well.
Yeah, time is a big thing. I guess we'll talk about that when we come on to deals and like trying to do acquisitions. Timing is a big part of that, right? So why did you go to PwC? Like, because you're an entrepreneur, you're in charge of your own destiny. Why do you want to then go get a job?
I think after that experience, I realised that I needed to learn more.
Okay.
And I knew that I wanted to be my own boss and an entrepreneur at some point.
Right.
My dad was, it was in the family. I could see it. I liked that creativeness, but I also realised that I was young. I still am young, but I was very young
yes,
then.
you are. Stop it.
Yeah. I was very young then, and I had a lot to learn. And I just thought, what better place to go and learn than to go out and support other entrepreneurs on their journey? Right. And that was what I really thought about doing. And I thought, actually, my career, and still, this is still my ambition, my career is to be deeply involved and at some point, have equity in a number of companies, a small portfolio, and I'm deeply involved in them, and I use all of my experience over the years to run and scale those businesses. I think that'd be a really cool journey to have, and I just thought that has to start with being a consultant to entrepreneurs, and learning from other really good consultants from the outside. I mean, it either starts with you do it or you help people do it.
Yeah. It's similar. Actually, the reason why, it's 21 years ago. The reason why I decided to become a business coach, having, I'd had some entrepreneurial success. I'd had quite a lot of failure. But I suddenly thought, hang on a second, I don't know enough at the moment, and I actually want to go. I want to go make a difference. I want to contribute, but I also want to get paid to learn. Yeah. And my version of that was, well, I'll buy a franchise and become a business coach and start helping people and learn that way at the same time. And that I just used a different vehicle. So it's interesting, we both kind of got to that point of actually we need to learn, we need to go back and develop ourselves more, which I think is something that I think not enough CEOs take an audit on themselves and go, okay, if my business is stagnant right now or it's struggling, it's a reflection of me. What do I need to go learn? What do I need to go and develop myself? How do I develop myself, right?
Yeah.
Do you see that with people you sort of chat to, through the ExpertEye business? Do you see people coming in, their numbers are stagnant, but then you look and think, well, that's because you haven't changed, or?
Yeah, I do think that. I absolutely see it all the time. I say to people quite a lot that there is a difference between 20 years of experience and the same year 20 times.
Yeah.
True. And that difference is, have you learned and developed along the way?
Yeah.
And the point is that there's no school for entrepreneurship and business, right? No. We have like a CAS business school, but the truth is it's all academic, and there's no school for genuine entrepreneurship and business. And the funny thing is that I'd come to the end of my academic career and realised that I didn't know anything about business, right? And I'd studied economics, I'd studied business, and I was in, more financy than most, and I still didn't really know anything about. I maybe scratched the surface. And worse than just scratching the surface, because of the fact that I'd studied all of those areas, I thought I knew quite a lot.
Right.
And actually, over time, realised that I knew very little at that point, right?
Yeah.
And I think it's one of those where the more you know, the more you realise that you don't know.
100%.
And I think that sometimes the value is in knowing what you don't know, because you can ask for help. And the worst position that you can ever be in is you don't know that you don't know.
Yeah.
And then you can't even ask for help, and you don't know why you're stuck, and you get, exactly as you say, you get frustrated.
Well, it's also the speed of change. I think the challenge at the moment is the speed of change, right? So if you go to an educational establishment, and I studied business studies, it's a useful grounding. But like, you and I yesterday, we were in the F12 Mastermind, and some of the stuff that was coming out there that people were showing they were using with AI and stuff, they weren't doing that 6 months ago. Now, if you're in a formal structured learning environment, that's really quite challenging to keep up. Whereas that's why I'm passionate about kind of like group learning, whether it's like an event or whether it's a mastermind, is that you see other people evolving really fast in front of you, and you go, well, that's a great idea. Then you take that idea and you apply it, and it's the speed of execution. You slow that down, you speed that up rather, in terms of like idea to implementation. Like you just proved it with something you shared to me before we came online. It's like hours from when you got the idea from being in that room to when you executed on it.
Absolutely.
And I think actually as an entrepreneur, one of the skill sets is going, okay, how can I learn and apply faster? And I think some of the business models that I've seen that really struggle with this is like if they've got a 12-month cycle because they only do one thing once a year. Yeah. So it's going to take you 12 months to learn something and apply it. Whereas actually if you're able to apply every month and changing the model every month, you get to a point where it scales faster.
Yeah, and I think that also depends on them realizing that they need to learn, and that they need to measure, and sometimes the worst part of this is that sometimes you don't realize, or you think you're measuring the right information, and actually you get to the end, you've measured the info, and you're like, well, I don't have enough, so I need to go and measure something else. And as you say, if you're on a 12-month cycle, well then you can't measure the information that you need to make the change until next year. Yeah, that's really going to slow you down.
So why do you think? Or do you see this in your work from the finance side of things? Do you think most entrepreneurs really understand their numbers?
No.
Why do you think that is?
The same reason that most entrepreneurs don't understand HR, or they don't. HR is a big one. It's a pain point for everyone, isn't it?
People. We just put it under the category of people.
People, yeah. Or we have to go and learn marketing, and
right.
And I think that what it is that marketing tends to be, for most entrepreneurs, the thing that they enjoy the most, because it's about being creative and it's about going out to people and sharing your message. Right. And I think a lot of entrepreneurs are in that energy. They're in that headspace, whereas finance is the refining side of the coin often.
Yep.
And I think a lot of entrepreneurs don't like that headspace. And
Yep.
so they know it's important. And so they will learn it to the extent that they know it's important.
Yep.
But they don't love it.
Yeah.
And they don't really want it to be, there.
Which is odd when you think the outcome is they want to make more money. And actually, if you ask them to, not everybody, I mean, over the years, we've run courses and stuff on like mastering margins and things like that. They're always the ones that people, they're the hardest to sell because people don't want to come to it.
Yeah.
You do a marketing course, sell that. Social media marketing, easy, sell that. And that's easy to sell. But actually, you take people through a process of like how to understand margins and difference between gross and net and so light bulbs just go off for people. And you're like, how are you working out how much money you're even making if you don't know the difference between markup and markup and margins?
Right.
Like that, even that sometimes, right? And I think a lot of entrepreneurs, and I've been guilty of this, will go see their accountant, sit down, the accountant puts the numbers in front of them and they just sort of look at them and go, okay, are we doing all right? And the accountant goes yes or no, and they're sort of like, okay, but they don't know that, the language of business is numbers, right? Whether you like it or not, it is the language. And if you're going to play in that game, at some point you've got to level up your finance knowledge.
Yeah. Yeah. Or get someone in the room who can help you.
Yeah.
But I think the problem with not leveling up your knowledge enough is that you find it very hard to find someone who can help you in the way they need to. And I think that's the second mistake that I often see. So entrepreneurs will realize that they've got a gap in their knowledge, that they don't, they need someone to help them.
Right.
They might bring in a CFO, but they don't know what they don't know exactly what they need.
Right.
And so they'll spend a lot of money with a CFO or, maybe a fractional CFO, but they don't know exactly how that solves their problem.
Yeah.
They just know that there's going to be someone to explain to them the problem. But I think that's the problem with that, is that they then can't hold them to account.
Yeah.
And they don't know what they're looking for. And that is a bit of an issue. Yeah.
Well, that's a really good point, actually. When do you think is a good time to bring in a fractional CFO on the journey? When do you think it adds the most value?
Much later.
So being when?
So probably when you're going from 2 to 5.
Right.
Yeah. I think up until that point, and the reason why I say that is generally when people bring in a fractional CFO, what they're doing is they're paying a CFO to do the work of a controller, so someone who's below CFO level, because they don't have the reporting frameworks, they don't have the control frameworks.
Right.
And most CFOs that you will want to hire, what their job is to do is to analyze the data and analyze your business and be the bridge between your entrepreneurial mind and the business financials.
Yep.
They're meant to come up with the money models. They're meant to come up with, actually, if we repackage things in a different way, we might be able to increase profits in across the board,
right,
for example.
Yeah.
That's what they're meant to be thinking about.
Okay.
But I think most people will bring them in to run a cash flow.
I think that's true. Yeah, I think most people do. They go, I'll bring in a CFO just to sort the cash flow out.
And I think that's probably the job of a good controller.
Yeah, that's a good distinction.
Yeah, and the CFO should be there to be able to draw the bridge between the business and the finance. Yeah.
I suppose it also sits slightly in the box of commercial in that sense, right?
Yeah.
Yeah.
Now there are some CFOs that I know, David, they've got controllers in their back end who can sort of support them, and therefore that's kind of I think the best of both, right?
Yes.
Because you've got someone to do it and then the back end. But otherwise, I say to a lot of my clients, we can help you with, just drawing the bridge and explaining the numbers to you. Just get a controller, get someone in.
Yeah. That's a really good point. I think I would probably agree. Below 2 million, I don't think it adds the value. And I think you're right. Really good controller and a really good, accountant. This is an interesting question. To me anyway, when do you know it's time to change accountants? Like, because I think there's a point here for entrepreneurs, and I've seen this, which is they outgrow their accountant, right? And then they feel guilty about leaving.
Yes.
Because they've been with them since the startup. But they've outgrown them, so they've got much bigger than the accountant. Number one, and number two, they're now playing a game where the accountant doesn't understand M&A or doesn't understand acquisitions, but they feel guilty about leaving them.
Yeah.
Do you see that?
I think it's before the acquisitions. I think it's with the tax. right? Tax
Right.
is the point. Tax is the point where it's time to leave your accountant. I always say that.
What? Hang on a second. Wait, so let me just. So when you say what? When you feel you're paying too much tax,
Yes.
or when? Oh, okay.
Yeah. So I always say that what you want from an accountant is someone who will be on your side
Yep.
and advise you on how to structure things efficiently,
Yep.
but not going to get you in trouble with HMRC.
Absolutely,
Right?
yeah.
You want to stay on the right side of the law. You don't want to be in trouble, but you want to just be as efficient as you can be.
Yeah.
And often in many small businesses, there's so many little things that they are just not aware of. And when you've got a small business, maybe making £50,000 a year in profit, those small things don't really add up. Maybe it will save you 300 quid or
Right.
400 quid.
Right.
But when you've got a large business, maybe make over 100 grand in profit, actually, I think people are often really surprised at how much they can save.
Yeah. I always say there's two things. There's the game. There's sort of three things around money. There's the game of making it, which entrepreneurs generally kind of figure out and get good at.
Yeah.
Then there's the game of hanging on to it, which is like not paying. Like optimizing your tax efficiency, being well structured, thinking about that stuff, and then there's investing it, right? Like there's those three games, and whether that's investing it in assets or investing it in other businesses or however you choose to do that. But if you don't play the middle game very well, if you're not keeping what you've made, ethically and correctly within the law, but optimizing it, if you're not optimized for that, you can bleed out tens of thousands of pounds.
Absolutely. And I always say this to people, on our scorecard. I was like, £4,000 a year tax saving over your working life is an extra £1 million in retirement.
Hang on, say that again.
So a £4,000 a year.
Right.
If you save £4,000 a year on your tax,
right,
or in anything, but if you save £4,000 and you keep it just invested in like a tracker fund or something, at retirement, it gives you an extra £1 million.
Yeah.
So every £4,000
wow.
that you are able to save over your working life, that's how compound interest. Right?
Yeah.
Over your working life is £1 million. And I just think people need to really think about that.
Yeah.
Because sometimes if we're saving someone 30 grand, and if we'd have come in 5 years ago, 10 years ago, you'd be sitting on a much larger asset position. And I think actually entrepreneurs, they're so driven to build their business that they often do neglect themselves.
Yes.
And that happens. That is actually my reason for becoming an accountant, because I see that.
Wait, to see what?
I just think that entrepreneurs create so much value in the world.
Agreed.
I think they are the drivers of change in the world, and absolutely positive change and creators of value, but they very rarely look after themselves.
Yeah.
And I think that they rely on advisors to support them to look after themselves. But unfortunately, or fortunately, whatever it is, the world is just that most people are average.
Yeah.
And there's no one who can help entrepreneurs sort of end the game at a better level in a way that they deserve. Because I think that, they think that their business is going to be worth millions, and that's going to be their retirement, and it isn't.
I think that's a really interesting point, because I think it's two things here. One of the biggest myths I think that holds entrepreneurs back or catches them out is that all accountants are created equal.
Yes.
Right?
Yes.
It's like, and you go, well, like all lawyers aren't created equal, and all business coaches aren't created equal, by the way. There are some that have got 20 plus years experience, and there are some that have been doing it for three years. It's a different game. And just because you've got the title of accountant doesn't mean you're the same. And some are really great compliance accountants, and some are really good at optimizing an entrepreneur's ability to save and be tax efficient. And I think you've got to realize as you grow your business, you've got to change your advisors too. You've got to level up your advisors. As you get to the next level, once you break $1 million, you need a different level of advisory team around you, whether it's HR advisors, whether that's business growth advisors, whether that's tax advisors. You start to need different advisors. And I think one of the mistakes I see people make is that they resist either getting advisors, number one, because they think they figure it out themselves, or B, they resist changing advisors and leveling them up because they don't want to pay more money for the next level of advisors, without realizing how much money they save them.
Do you know what? It's really funny, and I think that's it. It's really common, and a really great case in point in this is that we had he is now a client. He was very concerned that we wouldn't be able to save in the tax that we're saving. So I said to him, I was like, look, fine, we'll do a tax plan. you don't pay anything if we don't save you at least double the cost of the tax man.
Nice offer.
Yes, thank you.
Nice offer. Well done.
So we ended up saving him just 9 times the cost of the tax plan.
9 times?
9 times. And then he said, okay, well, should I get my old accountant to do that? My old accountant has started doing the year-end accounts, so I'm going to get them to do it, and then I get you to do it. Because I don't want to pay them and you. And I said to him, I was like, okay, but let's just think about this. Even if you pay us to redo the work, you're still going to be saving
this amount
of money. And in the end, I had to make another offer to him. And I basically said, okay, right, look, let your old accountant do your accounts. Just before you submit, tell me what the tax is going to be. And I will guarantee you that our fees will be capped at 30% of the tax, basically. That if we can't save you at least 3 times our fees, you don't pay anything, type thing.
Nice offer.
And yeah, I mean, obviously it worked and it was fine, but it was such a big reminder to me that sometimes people are, even when they know they're going to be saving, and even when they know they're going to be better off, they're still like a little bit reserved, though maybe this time it won't be. And you know, and I get it, because for a lot of accountants, for a lot of business owners, they're just looking for the cheapest accountant because they look at accounting as a compliance box ticking exercise.
Yes, so true. So true.
And therefore, they don't see the value that can be added.
Yep. Well, because a lot of accountants aren't adding any value either, by the way. A lot of them are just sitting there, turn up at the end of the year, go, oh, you had a good year, you had a bad year, here's what you owe in tax. I mean, the number of clients I've gone in and talked to, and we usually upgrade their accountants. It's kind of one of the things we'll not quite often do in the first year, because, you know, just 9 times out of 10 accountants haven't looked at them as they've grown their business. They haven't restructured what they're doing. You know, I was with a client the other day and we just taken on, and they had hundreds of, literally 100,000 plus sitting in their trading account, and their IP was sitting in their trading account, and there wasn't a holding company, and you're like, how long have you been with your accountant? And they went, 5 years. And I was like, how has your accountant not protected you?
Yeah.
And you're like, and they were, I didn't know this stuff. And they'd been in someone else's mastermind, and that coach hadn't mentioned it either. And I'm like, you have to get around people who are used to operating with businesses that are at the level you're at.
Yeah.
One of the things I think you should always ask your accountant is, right, you know, if I'm a 3 or 4 or 5 million pound business, how many people are you dealing with who are at my level? Because if you're the only one or one of 2, then they're learning on you, right? As opposed to like, how many deals have you done, or how much M&A experience have you got? So, well, if it's none, then don't find someone who's got experience, because otherwise you're paying for that education.
Yeah, I think the other side of this is that I think when I left PwC, I did out one of my first lead magnets was a graphic of the ideal finance function.
Right.
Yeah. And I counted, I think it was 21 or 22, I can't remember now, distinct roles within accounts. And in the SME world, you have one accountant who basically de facto plays all 22 of those roles.
That's a great insight.
And they are, I mean, well, you've got a pocket knife.
Yeah.
And what you want to develop as you start scaling is a load of scalpels, right?
Yeah.
You want distinct advisors for each area that you go into, that you are working on. And so you might have someone who, you know, and I think because of the fact of my background, you know, being at PwC, I was very used to being in the room with, you know, I'd be sitting in the room with a client, and there'd be, you know, KPMG would be on the other side, and they'd be doing the tax planning, and then there would be perhaps BDO, and they'd be doing, you know, other consulting piece, and we'd be sitting there as you know, doing the risk and internal audit and controls, and it was very natural when you are in larger organisations that they will pick and choose the advisor that they want to use for a particular project.
Yeah.
Whereas in the SME world, we don't do that as much. And I think that as businesses scale and get bigger, that's important.
Yeah. No, I think it's critical. I also think the reason why is, in my experience, is because most businesses start underfunded. They haven't got enough capital, so they're trying to save cost, and that becomes a sort of like paradigm that they just operate in. Is like, I need to do this for at least I can afford, I can spend.
Yeah.
And there's a point at which, and it's usually around 7 figures, when you start becoming a grown up. And you know you've become a grown up when you start investing in better advisors. When you start going, look, it's worth me spending £20,000 to be in a mastermind because I'm going to make $100,000 out of what I earn in it. It's like, that's a good return on my money.
Yeah.
And then it's worth sitting with you and getting tax advice because that's going to save me, £10,000, £15,000 a year. Now, if the government turned up tomorrow and put a tax on entrepreneurs that was going to cost them $5,000 a year, everyone would kick off big time.
Absolutely.
But because it's money you're saving rather than money you're spending, people don't prioritize saving and investing that money, right? That's the mindset shift. And I think you become a grown up when you're starting to look at your business and go, right, I need to take money out of this business for me as well. Personally, I need to do that. And I think one of the mistakes, I don't know if you see this, but I see this quite a lot, where entrepreneurs justify not paying themselves a salary, which creates a massive amount of stress in their personal life and their families and stuff. And they justify that because they go, oh, at some point I'm going to sell this business for millions and it will all balance out. Do you come across that?
I do.
Why do you think that exists? Why do you think they justify not paying themselves?
I think is because of. I think it all comes down to identity. Actually,
right.
I think that they see them that they're creative and they want to put everything that they can into building their baby.
Right.
Right, and that's how they look at it. I also think there's been this fallacy that goes around that the business valuation is going to be sort of. I've heard ridiculous numbers, but 10 times profit.
Yeah.
And. Or someone told me, oh yeah, but it's 3 times revenue, isn't it? And I was like, excuse me.
So let's that's a great sort of like segue into that kind of conversation, right? In terms of how do accountants calculate valuations?
finger in the air.
Don't tell me it's guesswork. Stop it. There must be genuinely where do they start?
Okay.
If you go to, well, I think, can I just say there's an interesting thing here. If you're listening to this podcast and you haven't had your business professionally valued in the last 2 years, please take one of the actions out of this show to go and get your business professionally valued. Because if you don't actually know what it's worth, how do you know whether you're growing the value if you want to exit at some point?
Yes.
Like, get a valuation every couple of years and go, what is this thing actually worth?
Yeah, I do think that's important. And joking aside, I think being in the know of your valuation is really important,
right?
Because it allows you to wealth plan as an individual,
right?
Because okay, well, what are my assets?
Yes.
What assets am I actually sitting on? And I think the problem comes was that when people don't do that, when they get to retirement, it's often very tough.
Yeah.
So I do think that's really important. How do accountants create value a business? Well, look, there's a few ways that it's done. Either we're looking at the assets of the business. So I love Ken explains this better than anyone
Ken
else.
Gorman, yeah.
So
he's been on the show. We'll link to Ken's podcast below.
So I'm going to nick his analogy of the cows because I think it's the best way, right? If you think of your business as a cow, you can either sell it for the fact that it could generate future milk, or you can sell it for the value of the carcass. And the business is really the same. So either we look at the assets of the business and just say, if the business stopped tomorrow, what's the assets worth?
Right. So in your case, assets being like vehicles or physical assets or IP?
Yeah, I mean, sometimes it's the client book.
Right.
In the SME world, if it's going to sell for assets, the most valuable asset is the client book.
Right. So listed customers, right?
Yeah.
Okay.
Yeah. So it would be that, but sometimes it is IP. Sometimes it's a website that's really well converting. So.
Yeah. Or you can also sometimes get asset value for social media. Somebody I know recently just bought a business, really small, relatively small turnover, but with 40,000 people on Instagram, and the value was in the Instagram following or that side of it. So the value can be digital and physical, right?
Yes.
Okay.
Or you can sell the business for sort of the future milk, or for future cash flow, or in the cow
future
analogy,
profits,
it's the future milk that it produces. And in the SME world, that's the most common used method.
Right.
And so what we do is we say, based off of what is the cash flow that this business generates, and then how risky is it that cash flow will continue that cash flow will continue to be generated in future years, and depending on the risk, I will inversely give you a multiple. So if the risk is low, I'll give you a higher multiple. If the risk is high, I'm going to give you a lower multiple.
Okay.
And it's all quite crude in the SME world and the best method to assess the risk that we use is basically the size on the first thing that we'll look at will be the size of the profits.
Okay.
Because if your profits are high,
Right.
for example, if your profits are above $1 million,
Yep.
they're inherently less risky than if they're below $1 million, right? Because there's more of them. So even if you lost some, you're not going to lose it all.
Yeah.
Or you're less likely to lose it all. And therefore, businesses over £1 million will have a higher multiple. They also have, they can generate greater leverage. There's a much bigger engine behind it.
That is a really kind of like, if you're going to play the game and grow big, and then I would say 7 figures in revenue is the first thing to get to.
Yeah.
Then the next big ambitious goal I think you should be going for is 7 figures in profits. Now, depending on your margins, you might be able to do that on 4 million turnover or 5 million, or you might need 10 million. But I think like once you break £1 million in profit, it creates a massive different amount of options from a wealth creation standpoint as an entrepreneur as well, right?
Yeah. That's part of the reason why I developed the SCORE framework. But
Yeah.
I think before we jump into that, I think what I always tell my clients, and I think is really important, is in 24 Assets, Daniel Priestley brings this thing of you've got the lifestyle business and a performance business.
Yep.
Right. And I think it is so valuable to know which of those you're building.
Sure.
Because if you're building a lifestyle business, you might reinvest in the business a certain amount every year, but your primary builder of wealth is going to be your method of extraction, taking the money out and putting that money. You have a personal vehicle to invest, and then you're investing in a series of other assets, be it acquisition, maybe property, maybe stock, whatever it is for you.
Yep.
You're investing in a portfolio of other assets.
Yep.
Because the lifestyle business is there to give you freedom and flexibility.
I agree.
And you want to de-risk your reliance on the lifestyle business. If you are building a performance business,
or grown up business is probably my way of describing it. Yeah.
yes, yeah, okay. I don't know if I agree, because you can have a grown up lifestyle business.
Okay.
Yeah.
Okay. That's an interesting. Okay.
But yeah, if you're building a performance business, then you're going to optimize it for exit value.
Okay.
And all of your assets is probably going to be tied up. Well, most of your assets are probably going to be tied up in that business.
Right.
And so each year, you might take out a small amount to hedge your bets, but you're going to want to be investing as much as you can in that, because ultimately a performance business at some point is probably going to look for private equity funding. It's
Right.
probably going to look for external investors, and you want to put that off as much as you can so that you can retain as much equity, so that you can take out, sell out at a highest valuation that you can.
Yeah.
And so I think it is really important before you start thinking about this, like, what do I really want?
I think I don't think I've heard you explain it quite like that, to think, okay, if it's a lifestyle business, then the tax strategy is about pulling out as much as you can and then investing it into other vehicles, be that, startups or property, or, like other, you might buy a franchise, who knows, other vehicles, right? So your goal then is to generate lots of profit, pull out that cash and then put it into other vehicles. Like that makes sense as a model. Then if you're going for a performance business and an exit, let's put it kind of like that journey, then you want to leave more capital in the business to fund the growth, number one, but to also retain share ownership. Okay. Yeah. See, I think strategically, most people aren't even clear on which of those two they're trying to do.
I agree.
And I think sometimes you get people who are trying to do the scale and exit journey.
Yeah.
And they're ripping out loads and loads of cash out of the business and then wondering why it's struggling. And it's like, well, you're using the wrong strategy in the wrong vehicle.
Yeah, you can't do both.
No, and that's a great insight. Actually, I think most people don't stop and go, hang on a second, which one am I building? And I think, I think sometimes entrepreneurs get, and I've been in this category where I'm building a lifestyle business and felt guilty about it. Like I should be building a performance business. Right?
Yes.
Like, do I want to at this point in my life? Actually, I enjoy investing in startups or tech, or helping other people scale, rather than going, I want to do my own scale and exit, because I did that when I was in my 30s. Don't want to do that now. But I think you have to. It's like sometimes it can feel guilty, like, oh, I'm not playing a big enough game. Well, that's fine if you're making £1 million a year personally and investing in other businesses. That's a great model. There's nothing wrong with that. It's a great model.
Yeah, I think also the nature of creativity is you want the freedom, but you also want to keep creating.
Yeah, that's true.
Yeah, and so you want the freedom of the lifestyle business, but you want to be able to do it. But I often think that, if you've got a lifestyle business and you've scaled the lifestyle business to be generating you, let's say, I don't know, £500,000 or 400 grand a year or something, a good number that's giving you what you need, and you've got the flexibility to do other things. Well, you now have the ideal, you've got the ideal a situation where you've got time and money.
Yeah.
So that gives you options.
Yeah.
So go out and do other projects, have other things.
Well, and also have some fun, right? Like, invest in some startups, do some kind of seed and angel investing stuff, and just have some fun with it. I think is taking that pressure off it, right?
Yeah.
So let's just talk. Can we shift gear a bit and talk about acquisitions for a moment?
Yes.
Because I promised that in the startup, and I really want to. Really interesting just to talk about the tax thing. By the way, just in case, we'll drop a link below the show. You have a scorecard for people if they want to find out how much tax they can save.
Yeah. So how likely you are to be overpaying.
Yeah. But there's a really interesting story attached to that, which I do want to come back to at the end of the show about that and marketing, and there's a big lesson for everyone at the end. All right. So Stay tuned. We will come back to that at the end. Remember, if you're enjoying this podcast, make sure that you subscribe if you're not subscribed, because we're going to cover loads of good stuff going forward, and want to make sure you don't miss any other episodes. Okay, so you've done 150 episodes at this point. Sorry, acquisitions. I've done 50 episodes, but you've done 150 acquisitions.
I've done about 40 episodes.
You've done about well, thanks for being on this one, right? So what's the single most common reason that you find when founders are trying to exit that they miss and they leave money on the table? When they're trying to exit, first of all, rather than do deals, like what's the biggest mistakes you see people making when they think, it's time to sell the business?
They wait too long. It ties into what we were saying before about valuation, right? You said that you should get a valuation early on, and I think that's really important. One of the reasons that it's really important is because you've got a line in the you've got a line in the sand. You've got something that you're measuring against, and you're watching how that valuation might change over time. I think the biggest problem that I see, or the biggest mistake that I see owners make, is that they're not clear on their valuation, and they wait too long based on an assumed valuation. So I've got 200 grand in profits, assume I'm going to be able to sell that business for 2 million. I don't need to sell yet. I'm very happy right now. I can wait 3 years. And then in 3 years' time, they're like, right, I want to sell my business. I'm done. I'm out. Let's sell it. And they realize that, it's a minimum 18 months to sell a business.
Yeah.
And actually, if you would have put 3 years into it, maybe 5, you would have been able to sell out for a much better number, because you could have done that when you still had energy. Now you're desperate to get rid of it. It's going to be much harder, and you're going to settle for a much smaller number than what you thought.
Yeah, also the market can move on you, right?
Absolutely.
It could be worth, like 10 million now, but in 3 years' time, if technology's come out and disrupted you, you might be worth 3 million.
Yeah, so I think that's probably the second thing, is that knowing when to exit. That sometimes you just need to take an opportunity, because I always say that sometimes in an industry, a few years ago it was in vet practices, right?
Yeah.
We're sort of now in sort of the accountancy practice, but private equity will come into an industry and they say, right, the industry is very fragmented. Perfect opportunity for us to come and do some roll-ups, and they'll put money in, and because they're putting money in, they are inflating the valuations in those markets. That's a temporary thing, and so if you've got one of those moments and you're nearing your exit, you need to take that opportunity, because that won't last forever, and it's just worth selling out in that time. That's your peak. But I always say to people, I'm like, if you're thinking about exiting in the next 8 years, 10 years, and someone can forward you all of that cash flow today, you're going to see that what's the point in waiting 5 years and then deciding that you're going to sell? And then you're going to sell for a much lower valuation. So if you could get 10x today, or even if you could get 8x today, but you're going to sell out for 4x in 5 years' time, well, you could have had the money today.
It's also the value of time, right? The value of time.
Yeah. And experience, by the way, because entrepreneurs always do better the second time around.
True. I think it's really interesting, because I was involved coaching quite a lot of vets around that sort of time, and we've had similar thing happen in dentistry too. And you looked at the multiples that the PE firms are paying, and it just made no sense.
Absolutely.
Like on any commercial, and people would go, "Oh, I might wait a year and see if I can get more money." I'm like, "You're getting 32 times profits. Like, what the hell are you? How much more do you need?
Yeah.
You know?" And it's like, look, this is the best opportunity you're ever likely to have. Like, do you need more than that? You're getting in, like, how much more? How much is enough? And I think that's the other thing. I think most entrepreneurs don't go, okay, don't have a decent financial advisor as well to go, right, how much money do you actually need invested to be able to not worry for the rest of your life?
Yeah.
And therefore, if you get that number done and someone will pay you that for it, then you're done, right? You've achieved that first level of freedom. But I think most people don't even know that, well, how much do I need?
Yeah.
They think they need more than they do, in my experience.
Absolutely.
Which means they stick around in the business longer than that, right? So let's talk about acquisitions then. When did you get interested in that, or kind of, what was it, PwC times again, or was it?
So I sold my business.
Yep.
At PwC, I was kind of interested in it. I didn't really help on that many acquisitions when I was there. I was more focused on sort of risk management. That was the department I was in.
Right.
So some of that was supporting people in acquisitions, but mainly it was just general business risk management. When my dad sold his business, that was what opened me up to this, because he was sort of the classic entrepreneur, thinking his business was worth one number, and actually it was worth less.
Right.
And luckily enough, he did save. He looked after himself, so he wasn't completely dependent on the business valuation. But he was then forced to sell because he became ill, and just couldn't keep working anymore. And he was forced to sell very quickly. Couldn't do anything about the valuation. Just took the number, and that was what it was. And I remember thinking at the time, just I wish someone could have advised him, the 10, 20 years previous. Number one, he probably could have been saving more tax. And number two, he could have done something about the valuation. He was more than capable of getting the number that he wanted.
Yeah.
It's just he would have had to change a couple of things in the business, and he was absolutely capable of doing that.
Yeah.
So it was not a capability issue. It was just an access to the right people.
Yeah.
To turn around and tell him, this is what you need to do.
What business was he in?
Fire safety. So he was
Okay.
he was an engineer. He had sort of a fire safety business. They did sort of extinguishers, all systems, all that sort of stuff. Yeah.
Yeah, I had a couple of clients in that space who've kind of like scaled, and one sold and then one acquired another one in that space.
Yeah.
So what was the first acquisition you were involved in then?
So the first acquisition that I was involved in that came off successfully.
Yeah. How many have you been involved with that haven't come off successfully? Do you track that metric?
I haven't tracked it actually, but the first one that I was involved in didn't come off. That was one that it just didn't happen. But the first one that I came across, that was involved in, that did come off was actually it was a nursery business. It was a nursery chain.
All right.
Yeah. And so it was someone who was building a small group of nurseries, and he made a couple of acquisitions. I got involved in that. Actually, at that point, it was just in valuations and actually post completion,
Right.
Just with completion accounts, and that was my route in, actually, because we saved quite a lot of money on the completion accounts, just because of the fact that I thought about completion accounts the way I did when I was at PwC.
Right.
As I was thinking about,
Well, I'm going to be really, like, I don't know. What are completion accounts?
okay, so when you when a business sells, let's say it sells on the 1st of January,
Right.
you prepare a set of accounts that basically finalizes the balance sheet
Right.
at that date.
Okay.
And those are completion accounts.
Right.
And you've got, let's say, a few months to prepare them, but based off of the completion accounts, you will make an adjustment to make sure that you've left the right amount of working capital in the business,
Okay.
depending on what was in the sales purchase agreement.
Right.
So there's quite a lot of opportunity there in terms of, number one, the clauses that you can put into the sales purchase agreement.
Okay. Like what? Give us an example.
What's the process for writing off debtors, for example? That's probably the easiest one. So
Right.
let's say, for example, let's say very, very common manufacturing company, we've got on their debtor book, we've got debtors that are 30 to 60 days old,
Yep.
60 to 120, 120 to 180.
Right.
And at what point do we raise provisions? At what point do we write off debt?
That's a great question. Yeah, because you got to think about that if you're exiting, right?
Absolutely. And if you're making the acquisition, you don't want to be taking, because you're going to be paying for that as an asset,
Yeah.
assuming that money is going to come in.
If it doesn't.
If it doesn't, you want to be protected. So,
yeah.
So I mean, that's the first one we always go for. But there's a whole list, depending on what we do in due diligence. Basically, what we do in due diligence is we find out what are we concerned about in this business.
Right.
And then we review the sales purchase agreement to think about, okay, well, based on what we're concerned about in this business, what clauses do we need to include in the sales purchase agreement,
Right.
and what particularly around the completion accounts. So what to ensure that there's enough working capital in the business to
Right.
keep it going, keep it healthy. And then in the completion accounts, we make sure that money was left in the business. But for example, in the case I've just given you, if we write the policy and we say that we're going to increase anything over 120, normally you get paid within 120 days, anything over 120 days, we're going to put a 50% provision. We will write that. If we write that policy in the sales purchase agreement, that's it. It's done. It's in stone. It's in when we do the completion accounts, you write that provision. That money comes back into the company,
Right.
because the selling owner has to pay it.
Yeah.
And the important thing is, from a seller's point of view, is that particularly if you're selling out to private equity, they know this stuff, right? And they will sneak things into your sales purchase agreement. And so often clients will say to me, well, yeah, I'm selling the business. I'm very happy. It's very simple. Why do I need my accountant to review it? And I always say, I'm trying to explain to them that this is what you're looking out for. They will put clauses in. It's not going to be clauses that are going to take away the full £1 million. They're not going to reclaim large time, but it's going to be enough that it's going to be painful. Maybe £10,000 here, £20,000 there. That does make a difference. And you don't want that money reclaimed. You want to make sure that it's fair, that the business has enough to continue, that it's got healthy working capital to continue. You want the business to be successful, but you also don't want them to take advantage, and you need someone to make sure that that's not happening. And that isn't what the lawyer does. The lawyer does that in all the other clauses.
That's really interesting. The lawyer doesn't do that.
Not on the financial clauses.
Right.
Yeah. So generally, the financial clauses and the financial clauses and the completion accounts clauses, the lawyer will normally turn around to the accountant to do. And it's funny because I've spoken to a couple of lawyers about this, and they say to me, they've said, is that normally we ask an accountant, are the clauses okay? And they say yes. But when we ask you, are the clauses okay? We get a 1-page document with what the clauses should be, and if they push back, what we need to negotiate down to.
Right.
Yeah, and that just is not done.
I didn't even know that was a thing. That's an area of expertise that you have. That I would suggest. I didn't know that was an area of expertise that you had either.
Yeah, I mean, it's part of what we do.
Yeah, but that's the challenge, isn't it? If you do 150 deals, it's just part of what you do. I didn't know you should necessarily. I've not heard other people talk about like you want to look at those clauses.
Yeah, I mean, it's the small things that add up, and they do.
Yeah. So okay, so you've done 150, or you've done 150 deals, or helped clients do it.
Yeah, been involved with 150.
Yeah. What are two of the best stories, and then what's one of the ones you look back and go, that was not a good deal?
Car crash.
Yeah. Give us the positive one, like the best deal you've seen go through, if you can, like just as a high level. Like, what was a great deal you saw someone do?
And one of the most incredible deals I've ever seen was it was a client who came to us. He was buying it was in construction, and I didn't really understand exactly the mechanics of it, but it's basically they made the foundations for large buildings.
Okay.
And it was a very niche business that was very good at creating these sort of iron steel foundations. Right. And they that business was being sold off from a branch of a much larger company,
right?
Because it wasn't there. They wanted to divest from that area. They didn't want to focus on it, and it was just taking too much of their attention. But massively profitable. I think it was making £2.5 million a year, and they were happy to they sold it to him for 10 million. He got 5 million up front, which he financed. 8%, and then he'd basically it was 8% interest only over 5 years. So fantastic, 400 grand, and the remaining 5 million was paid over the next 5 years. So
wow,
yeah. So deal.
Good grief, that's a good deal.
Yeah, cash flow positive, really, really healthy, fantastic deal. He was in the space as well. He knew the industry, and it really, I think, has been. I don't represent him actually anymore. I recommended him up to a colleague of mine at PwC, because I think he's now going for like a 150 million exit now.
Wow.
Yeah, fantastic. Really, really great client. Well, great story. Probably one of the best. Another one of the best. Actually, this is really interesting. So it was a client of mine who came in. It was a consultant, not HR, a recruitment consultant.
Right.
And he was thinking he wants to go on his own. He's been sort of he basically just the company that he was at promised him partner. He'd been basically running the business. The owner was exiting. Really, honestly, from the exiting owner's point of view, this is bizarre, stupid decision. The exiting owner basically screwed him over and said, "I'm not selling out to you." And he said, "Fine, that's it. I'm going to leave." And so he left. And he didn't want to start from scratch. So he thought he'd make an acquisition. And I was sort of saying to him, "Yeah, okay, fine. You probably want something about £1 million. You've got some sort of structure." And he thought about it, went back, he said, "Let me come back to you." And then he said, "Actually, I don't want that. That's too much for me. I'm going to take something 500 grand
right.
revenue. I know it's going to keep me very operational, and I'm operation heavy, but I think I need that. I need to go on that journey and take it to £1 million before I can buy £1 million business."
Right, smart.
And I just thought, do you know what? I work in an industry where that humility doesn't exist very often, and he had it. And it worked fantastically well.
That's self-aware, isn't it? That's
really.
I think you talk about it about I think I made a note. Some of you said, I heard you say, you talk about the business is a mirror for the founder. And
yes.
I think right there, that I think one of the skills of leadership is to have a level of self-awareness of going, actually, I don't yet have the skills to buy and run a 3 or 4 or £5 million business. And one of my pet hates in my industry is people running around teaching people to buy businesses that they've never run before. Like, hey, buy this business for £2 million. Yeah, but you've never run a £1 million business. You've run a 250 grand business. Like, you don't have the skills or the mental capacity to deal with this yet.
Absolutely.
And I've seen too many people get hurt and seen them crash and burn from doing exactly that. And I think one of the number one skills of a leader is to have that level of self-awareness of, I'm good at this, I'm not good at that, I have that skill set yet, or I don't have it yet.
Yeah.
It's a smart guy to know that, and I think that's a really smart play. What's a car crash then? Come on.
The car crash is probably it's probably the polar opposite of this, most polar opposite that I could find. And it was someone who came in, I won't give too much details because, for obvious reasons, but it was someone who came in, they bought a £12 million business. They would currently running a £150,000 business.
That's a totally different ball game.
Yeah, and they bought a £12 million business.
I mean, I admire the ambition. I think, like,
it's funny. That's what I wrote in my book.
We'll talk about your book. It's coming out. Yeah, but like, what you got to admire the ambition. Absolutely, think big, swing for the fences, and all that stuff. But like, the risk profile on that's pretty massive.
Exactly. And you know what? It was a healthy, really healthy business. But because of the fact that they had no idea how to run the business,
right?
You know what? Were
they not in the industry either?
No, so they were in the industry, but
right.
It's a completely different beast.
Well, to go over 10 million, you're at audit level too, and all that.
And the thing is that it's exactly what we said before, is that ultimately, if the leader of the business is a 200 grand leader, then somehow the business is going to come out to match them.
Yep.
And if the business is a 20 million pound leader and you buy a 200k business, at some point the business is going to come up to match you.
Yep.
And that was exactly what happened. It wasn't immediate. It took time, but over 18 months, business absolutely car crashed.
Yeah.
And then there was a long liquidation, and that was painful. And they got put into liquidation by a creditor. They lost control of the liquidation, which is the worst position.
That's the worst situation to be in, isn't it? I mean, I've had a business, it was, crikey, going back 12 years now, but I had a business that went into administration.
Yeah.
And it was forced administration by 2 creditors. And I think we had 7 days to get it to get it into liquidation ourselves before they take us to the court and do it. If you and the advice I got, and it was great advice, was just if you lose control of this, you'd be better to go under yourself and then be in control of the process.
Yeah.
You lose control, it's a nightmare.
And so normally I would tell clients, you don't lose control. Let's pop it. The business is insolvent. We need to liquidate it. Let's do this. Get ahead of the game. When I told them, they didn't listen because they thought they could save it. Again, ego.
Yeah.
And they thought they could save it and tried to save it and then ended up losing control of liquidation. That was terrible.
Can we just take a bit of a side road for a minute and talk about this? Because I think if you're an entrepreneur and you play the game long enough, you are going to have a business of one or two that fails, right? You're going to have stuff that doesn't work out. Like nobody hits home runs all the time, okay? And certainly in the early parts of your journey, there's a pretty good chance you're going to get stuff wrong or you get caught out by technology. I think nobody really explains very well what the process of going into liquidation even is and how it works. Could we do a quick, and how it's a tool to actually help you come back if you use it right?
Yeah. Okay, first of all, you do have to be careful because there's lots of anti-phoenixing laws. And,
we don't want to do that. Yeah. We're not trying to screw people over, put the company under, buy it back.
Exactly.
All of that, right? But I'm just saying, when is it a tool that is useful to restructure a business to come back stronger?
Yes. So if a business is genuinely insolvent and the liabilities are greater than the value of the assets,
right?
Then, what that means is that if I were to sell the trade of this company, I wouldn't get enough to pay off the liabilities.
Got it. Right? So the people you owe money to.
Yeah, exactly. The creditors in the business, the people you owe money to, have grown so far beyond what I can or what this business can deal with. Now, in that case, business is insolvent. It goes into liquidation. And essentially what you do in a liquidation is you hand over the keys to the liquidator and you say, I no longer run this business anymore. You run it. Take it.
Right.
Yeah. And what the liquidator will do is they take their fees. So they're allowed to...
Which everybody forgets about, by the way.
Yes. So they are...
How much are you taking out of this?
Yeah. They take their fees and they get paid first.
Yes.
That is the thing of the liquidator. And then they will sell off all the remaining assets and use whatever's left over to pay the creditors something. Now, there is a bit of a priority. So obviously, employees will get paid first. Pension schemes will get paid first. If there's anything left over, then it will go to creditors. And it will go to creditors in sort of a percentage, depending on how big they've got. Yeah.
And shareholders usually last.
Absolutely last, yeah.
Which is just worth understanding as a shareholder.
Yes.
You're the last one.
What you could do is, to the extent, it has to be done at arm's length, it has to be legitimate. But in some cases, you might be able to buy back the business or the trade of the business, and then you have to pay for it.
Yeah.
But it's less than paying for the liabilities, and we're doing it. It has to be done legitimately. But if it is done, then that can be a useful tool. Yeah.
You've also got to know though that fundamentally there's a sound business there, right? Otherwise, if you buy it back, you're just going to make the same mistakes again.
Yeah.
Which I've seen people do as well.
Interesting piece of psychology though. And I find this with it, and I think there's studies on it as well, is that people who just sort of pull off the band-aid, and they declare bankruptcy or they declare liquidation, if you cycle 5 years later, they are doing much better than the people who try and fight it out and save themselves from the liquidation. Yeah, because the fact that trying to get your head back above water is so painful, and just sort of saying, do you know what, I'm cocked up, it is what it is, or we've blindsided, took too much
industry
risk,
took a turn,
whatever it is. Yeah. Draw a line, learn a lesson, and move forward, bounce back. We know people who've done that.
Yeah, Nick Manuel on this podcast talked about how he rebuilt from the ground up into 7 figures in 12 months.
Incredible.
Yeah.
And I think that sometimes people they're floundering, and they do much worse because of the fact that they never really. It takes them so long to actually catch up.
Yeah, I mean, there's a great piece of advice around that I got once as well, which is one of the things that really cripples entrepreneurs as being investors is they lose money in a business and think they have to stay in that business long enough to make the money back in the same business, rather than going, actually, I just need to make the money back. If I can make it back in a different business or a different vehicle, that's actually all that counts. But we kind of feel like, well, I lost it in this business, therefore I've got to turn this business around, or I've got to make it in this industry again to prove a point. I think is an interesting... Are you fascinated by psychology then? Is it something
I am a little bit, yeah.
Yeah.
I mean, I often say, sometimes, well, yeah, I often say that sometimes I feel like I'm more of a psychologist than I am an accountant, because you have a conversation about people's accounts and then you end up talking to them and sort of solving all the other problems that they're going through.
Because they're trusted. Accountants get invited to weddings and all kinds of stuff, right?
Yeah.
So let's talk about your score. So you sort of mentioned, you dropped it in earlier, but I don't think we really unpacked it. So you've got this framework called SCORE. Is that what's coming out in the new book?
Yeah, so that's
right.
So what it was is that actually when I thought I understood valuation when I was at PwC.
Right.
And then there was a business that I looked at in COVID. I remember it so clearly. I took the call. I was in the garden. It was a fantastic business owner. She was incredible. Everything you want in a successful entrepreneur who's looking to make acquisitions. Humble, clever, intelligent, everything. Really, really good. We've had lots of years of experience. And I said to her, I was like, listen, business is doing fantastic, really healthy. It's doing really well. It's got a great pipeline. It's got a great pipeline. It's healthy financially. Forward looking looks really good. You're all clear. Due diligence looks good. And she said, thanks. I really appreciate that. It's really helpful, but I'm not buying it. And I said, why not? And she said, the culture's crap.
Wow.
She's like, I went into the business. Everyone's fighting. The owner wasn't there. It was the first time I'd been. The owner wasn't there. People are fighting. There's bitching about each other. People are sleeping with each other. She's like, horrible, absolute train wreck. She was like, I'm not touching it with a barge pole. And I was like, wow, okay, this is interesting. And I knew that she was right, but I couldn't rationalize it with the models that we had, conventional models of valuation.
Right.
And I just thought, well, do you know what? These models are missing an absolute trick, because culture, team, these things do impact the value.
Yeah.
And logically, we know that as accountants. That really, when we say a multiple, that's what we're talking about when we're talking about the risk profile of the business, right? We just find it very hard to actually give those things a place in that valuation. And so we default to what we can easily measure. But I think for a business owner, it's really, particularly an exiting business owner, but also an acquiring one, it's really important for them to understand what drives that valuation.
Right.
So that's why I came up with the SCORE framework.
Right.
Because I wanted to try and capture that. And basically what it is, if we just rattle it off very quickly.
Go for it. What do they stand for?
So SCORE...
We'll come back to that one in a minute. What is? No, we'll come back to that. Jim's jumping ahead. It's exciting. We'll come back to culture and we'll use it then.
For sure.
It's all good.
Yeah. Culture is a big part of the SCORE, actually. Yes. So the SCORE framework, so it's systems.
Yep.
Which obviously doesn't need explanation. There's all the systems that go behind the delivery of your business. Then we've got the commercial side.
Okay.
So how you win work, what your money model looks like. And so then we've got operations. So that's your team and how the organization is structured.
Right.
Then we've got the regulatory side. So what do your legals look like in the business? What's the legal risk exposure? And the last thing is exposure or risk. And so now the last one, exposure or risk, will absolutely cap your multiple.
Your multiple.
So, and each of them, in the book, I've come up with what I think is an initial sort of weighting for each of them, more heavily weighted to team and commercial.
Right.
Because I think those are ultimately, if you think about what people are buying, they're buying forward-looking cash flow.
Yeah.
So I need to know that you've got a good pipeline of work coming in, and a process to do that, and I need to know that you've got the team to deliver it, and you've got a really good culture, and that without you there, it's not going to fall apart.
Yeah.
And that is all in the team. And that is an all intangible asset in the culture of the business.
I think one of the indicators, if you're looking at culture, is like what's the team turnover number. And I was talking to somebody recently. They brought us in to do some work around their team dynamic stuff, and they had like 70% turnover in the last 2 years, and you go, right, there are some fundamental issues here with culture, because like people shouldn't be leaving at that level, and it was 35, 40 people. So the turnover on that in 2 years was like the whole team was almost different. There were like 3 or 4 people left who were there 2 years ago, and you just go, the cost to the business of that, but also the risk to that, right?
Yeah, absolutely. There's no way of working. You can't have a standard client relationships. There's no client relationships.
Yeah.
So then,
and you lost a lot of knowledge of people because nobody been there. Very few people have been there for more than 2 years.
Exactly. So whatever your processes look like at that point, it has to be capped. I've actually now sent it off to someone who works at Columbia Uni in the finance department, and we're trying to get them to test it and see how that actually stacks up.
Nice.
Yeah, because I think that'd be important and valuable.
Yeah. Was this where you got passionate then about your own culture in your own business? Because obviously your business is scaling right now. You're very close to breaking through the 7-figure level and becoming a 7-figure business in your own right. Hope you don't mind me saying that.
I don't.
Which is cool. But like, when did you take culture seriously in your own business?
Do you know the biggest problem with being an advisor is that it's often do as I say, not as I do.
That is a risk. Yeah. That is a risk.
I would love to say that I take my own advice because, sometimes you just forget it when you're looking at yourself. I was talking to someone yesterday in F12 and they were saying it's really easy when I'm looking at other people's businesses and to know what to do. It's much harder when you're looking at your own. And I think for me, I'd love to say that, I knew intrinsically that culture was important. I did know. But no, that's not what triggered it. What triggered it was really painful. Like I just kept messing up, and I was, I just had to evolve as a leader. And as I evolved as a leader, I realised that the culture in my business just wasn't where I wanted it to be, and that's when I put the work in.
Cool. Well, we'll come to that. I thought I'd tell you a funny story though, because one year, I can't remember if it was the last couple of years ago anyway, exactly that whole kind of thing that we had this conversation as a team about, like we need to walk our talk. It's one of the cool kind of values for us. Like if we're going to say it, we've got to do it. So I actually put one of the team in F12 for a year to sit at the back of the room and go, anytime I say something that we're not doing, make a note of it, and then we'll go and then we'll go back and do it. And honestly, that year it was really funny because thinking about it out loud now, like the business doubled that year. And it was because someone in my team was going, yeah, you're saying we should do that. We don't do that. Right. So then we did it. Right. And it was like, okay, all right. I probably ought to do that again at some point and go back and go, right, what am I saying now that we're not doing now?
Yeah,
so let's go through just because I think this model is really useful. Like, how did you come about? So we'll put it up the screen. So if you're watching on YouTube, you can check it out. So how did you come about with creating these set of values? Because I think values are everything. You should recruit to your values, you manage to your values, you lead from your values. How did you go about creating this and walk us through them?
Okay, so it was at the lowest point of the business actually that I came up with it, and I just thought, do you know what, there was one person in the business that I really trusted and I thought embodied most of the values,
right?
But I couldn't really put my finger on exactly what it was I wanted from that person.
Right.
And what was it that made them unique. And then so I just thought, I need to think about what do I want in my business. I think normally it'd be really helpful to do it as a team, but I just had no one in the team that I wanted to be part of the future.
Right.
Or only one person. And so I thought about, well, what is it? Let's break it down. Let's think about it and try and be consciously competent rather than unconsciously, and just think and I drew a lot from it from my PwC days because they were very strong on values and the core values. And so the first one that I always remembered was growth, like you have to be growth minded.
Yeah.
And so that was like just drilled into us. And I just, okay, fine. So I've got to have growth minded on there. Just need to make that work. And then then I started thinking about what else matters. Well, it matters to me that we're always respectful, we're always open-minded to other people's opinions. It always matters to me that, I've got a very diverse client base.
Right.
I've always had a diverse team.
Yep.
People come from different backgrounds. I think that's valuable. People should be comfortable listening to things that they don't like.
Yes.
And so let's just be respectful of other people's opinions.
Cool.
And that was really important. Ownership. I think it went hand in hand with growth minded. And actually, when all of these are things that, well, this is what I want our firm to be like.
Yeah.
Wow Focus is probably the one that's most aspirational for us. Is like, well, but I think that's what we need to hold ourselves to. Right. We need to be aiming to be so good that we put a smile on someone's face.
Yeah.
Yeah. Because if you've done that, then you haven't just. Then I've lived what I'm aiming to do. Right?
Yeah.
I haven't just helped someone with compliance. I've changed their life positively.
Yeah.
Even if it's a small thing, I've changed their life.
But I think there's nothing wrong. There's an important point there. There's nothing wrong with having values that are aspirational. I think sometimes people think, oh, we're not living this, so I can't have it as a value. Well, you can have it as aspirational value.
Yeah.
I think that's great. Look, this is where we want to be. We're going up the mountain. We're up the scale up mountain. It's like, that's what we aspire to be, this kind of a company.
Well, at the time I built this, everything was aspirational.
Yeah, but that's the foundation, isn't it? That's what foundations are for, right? Like, you can't build if you haven't got them.
Yeah. And then just being creative and open and honest with people. And I think that.
So thoughtful was the next one. Why'd you pick that
so
one?
thoughtful is about being creative. That's what it is. It's about coming up with we come up with simple solutions to complex problems. That was what it was.
Oh, I like that. That's really cool. I like that.
I don't know if it's on there, but it definitely.
It doesn't actually say that.
Yeah.
No, but I like that language. I think it's really good. And then honesty at the back.
Yeah. So honestly, I just think it's, you know what, everyone cocks up. And I wanted to create a culture where it's not that it's okay to cock up. I don't want everyone cocking up every 5 minutes. But that if you do and you take ownership, I'm never going to have a go at you.
Yeah.
And I'm going to value the fact that you've made a mistake, you've learned from it, you've told me what you've learned from it, you've thought about it, and you're never going to make that mistake again. Fantastic. Okay, you've taken ownership, you've been honest about it, let's do it. And we should do the same with the client. Let's be honest, tell them what's going on, what's the problem. And it came at a point where people were just making mistakes and covering it up, and I really didn't.
Transparency for me is such a big thing. It's absolutely. Like, I don't mind you making a mistake, I just don't want to hear about it from the client. I want to hear about it from you before I hear about it. Like, if we mess up, yeah, fine, tell me, fix it, and then move on. It's like, great, look, that's speed for me. It's like,
absolutely.
And also I think honesty is important now, because I think in the world we live in now, very, very often entrepreneurs don't get honest feedback from people around them. And if you're their accountant or you're their advisor, and they, somebody sat down F12 to me and said, "Can I ask you a question?" I said, "Yeah, sure." And they said, "Because nobody else will give me an honest answer, but I know you will." And I was like, "Yeah, that's what this group is about. Is that we won't. If we go, is this a good idea, and we think it isn't, we'll say no, that's a bad idea." Whereas like everyone around you, there's a risk that people just say, "Oh, it's a brilliant idea," even when it isn't.
Yeah.
And I think that whole kind of like, you need to have an accountant who can be honest with you and go, "Look, your business is in trouble if you don't sort this, or your margins are going in the wrong direction. You got to fix it." It's like, rather than just sit there and give you, "Oh yeah, you had a tough year," the platitude stuff that isn't remotely helpful. How often do you think you should meet with your accountant?
I think twice a year minimum.
Okay.
Ideally, I think once every 3 months, 2 to 3 months.
Yeah, I think it's size dependent though, right?
Yeah.
If you're over $1 million, I'd say you should meet every 6 months.
Yeah, I agree with that, and I think that sometimes there is a case to meet every month. It's size and situation dependent as well. It depends what's going on.
True.
It depends. Yeah, so I don't think there's any set rule.
So if you're doing a deal though, so if you're doing an acquisition, how long does that take? So like, I'm thinking, like, is that a 3-month process when you
from where are we measuring from like, initial? I want to make an acquisition to completion,
or I found a deal. I found a deal. Do it from I found a deal.
Okay, so from I found a deal to completion, I think it can be done in 2 or 3 months.
Right.
More commonly, probably 4 or 5.
Okay, so if you budget for 4 or 5 and you get it done quicker, then that's a win.
Yeah.
When people are selling, how long do they think it should take to sell it?
Minimum 18 months.
Really?
Expect 2 years. Yeah.
Yeah.
Because look, it takes time to find a buyer. You don't just want a buyer who's going to give you the biggest number. I know everyone thinks that they want the biggest number, but actually,
Ken says that on the podcast. He talks about finding the right buyer.
Yes.
Is more important than just finding a rich buyer.
And I've seen that more often than not. People will take lower numbers if they feel like it's the right buyer.
Yeah.
Even the people who say, "Oh yeah, I just want the biggest number and I want the most amount of money and whatever." When it comes down to it, push comes to shove, they will take the buyer that they think is the right fit for their business rather over a buyer who's giving them a bit more money.
Yeah. So right fit's critical, isn't it?
Yeah.
Especially if you care about the team, right? You don't want them to come in and mess the team up.
Yeah, and generally business owners, they care. They do care. They want their business to continue. And don't get me wrong, if it's going to be a material difference, it's not going to be the same. But within a margin, that absolutely they want the business to continue and they want it to go to the right buyer.
Where do you see the biggest opportunities right now in the market for acquisitions? Where do you see? Because I think you talked about it in F12 once about the baby boomer wave, and like just talk us through that. Where are you seeing opportunity at the moment?
So I think that we are sitting through the biggest transfer of generation of wealth that we have seen, and I think that this is the opportunity of our generation, not just in acquisitions, in all areas.
Right.
And I look at that and I think, well, there's a lot of businesses that are going to be sold over the next few years.
Well, do you think I think the risk is they're not sold, because I think if they're not sold and they get closed, we're gonna have a lot of people coming out of employment that aren't looking for jobs to change.
You're right. It's exactly right. There's a lot of people who are going to be retiring. I think I've worked at this 25% of business owners are over the age of 60.
Really?
Yeah, and 30 or 35% are over the age of 55. And I can't remember exactly the numbers, but it's around that. It's a big proportion.
Well, and you've also got the next generation doesn't want to own those kind of businesses, right? They want to be social media celebrities and YouTube stars and stuff like that.
And they're boring for them because they are boring businesses. They just happen to make a lot of money.
But boring is brilliant, right?
Yeah,
But I think that's, if you look at it, I remember seeing a statistic that said, like, what's the average income from people in the creative industries? And it was like less than $35,000 a year. And you're going, wow, okay, that's like, it looks glamorous from the outside, but it really isn't paid very well at all. And then you go, okay, great, you could run a really, boring steel manufacturing business and be making $500,000 a year, but it's not very glamorous.
No.
But like, that's ego again, isn't it? It goes back to that ego stuff.
Yeah.
So that's where you see the opportunity. And what do you think that's a 5-year window we've got with that right now?
I think people are rushing to say that it's a 5-year window, but people have been saying it's a 5-year window for 5 years. I think it's longer. I think I always encourage people to sell quickly. I know you also say this, that, don't hold on to your business for too long. Do the cycle a number of times. Think of yourself as an entrepreneur. You build a business, you get it to a point, you sell it, and you start again.
Unless you're go back to the lifestyle conversation before. If it's a lifestyle thing and you love it, like I've been doing the coaching and training business for 20 years. I love it. It is more lifestyle based.
Absolutely.
For me, for sure. But also, like, I want to do other things and play and invest in other stuff. So yeah, they're the cycles I'm running. They're just different cycles.
Yeah, no, and I agree with that. That's true. So I think that generally most business owners, even when they get to 65, they're not willing to really give up.
Yeah, they don't want to retire.
And I've seen owners selling in their 70s and 80s. I actually saw someone who was selling. He was 98.
What?
Yes. And I remember talking to the buyer about it, and I said to him, I was like, he's not going to sell you this business. It's just not going to happen. Like,
why do deals fall? We're done with that. Thanks for that. That's great. So why do deals fail or fall over in your experience?
There's a number of reasons. Number one is I think for me, actually, one of the biggest things is the identity of the seller.
Right.
There's a lot of psychology around what the seller's headset and what's going on for them, and they think they want to be out and all of these things. But actually, what I tend to see is that they have a real identity crisis, because that business, being the owner of that business, was their identity for 20, 30, sometimes 60 years.
Yeah.
Right? And so that's a big shift, and it's often very hard for people to get over. I think the other thing is sort of the deal going stale, and that's where a good business broker can help, because they keep the deal alive. They keep everything ticking over. They will tell people when to. You're going over the top with due diligence here. You don't need the answer to that. Come on, let's keep the deal moving.
Yeah.
not there are very. It's hard to find a good broker, but when they are good, that's what they do. They do that, and they do that really well, because deal fatigue is a real thing.
Yeah, it is.
And we just all sort of give up, and then a lack of trust between the buyer and seller. I think that one of the most important things that sellers forget to do is invest in the rapport between them and the seller and the buyer.
Yeah, great tip.
I think it does two things, actually. The first thing is it keeps the deal alive. Well, I say it does two things other than just being a nice person.
Being a good human being,
exactly.
Which we should aspire to anyway.
Yes. But other than that, it keeps the deal alive, and it keeps you need to have trust and an open relationship with each other, so that you want the seller to be able to be forthcoming with information that's in your interest. The second thing is that I often say to people, I'm like, if you like the seller, there's a good chance that you're going to like the people that he's surrounded himself with.
True.
Yeah. If you get on with them, culture comes from the top always. And so if you get on with the seller, there is a good chance that you're going to like the culture in the business.
I like that.
The feel of it.
That's and also, I think people are afraid to have a relationship in that instant, like go for dinner with them or build that bridge, or and it's like, it's not combative. It shouldn't be a combative process. It should be look, we're a good fit for each other, and actually I want to take over your business and make it better or continue the legacy, and you want to walk away feeling like you left it in a safe pair of hands. This isn't a kind of a combative, or it shouldn't, in my opinion, it shouldn't feel like a combative process.
I agree. And again, I do think it is another value of having a good broker in your side, because they can play bad cop and allow you to nurture the relationship.
So you've written a book. It's pretty much it's probably out at the moment, or coming out. It's out very soon.
Yes.
Depending on when the podcast comes out. But so I think it's called Finding Gold.
Yes.
So talk me through why did you write the book, and why should somebody go buy a copy?
Okay, so I was triggered to write the book because I saw two people who I respected in business.
Right.
A buyer and a seller. Buyer had made acquisitions before. Seller had run many businesses, made acquisitions, sold businesses before, done really well. And the deal happened, and post the deal happening, I noticed the buyer of the business making a series of mistakes. And every time he made a mistake, I deferred to him. I was like, well, look, he's done this before. He's actually done this before.
Right.
I've advised on it before, but he's actually done it before. I'm sure he knows what he's doing, and let's see how it plays out. And after seeing how it played out, I realized, actually, do you know what? I do really know this. I know enough about what goes wrong. I'm not saying that I'm sure that at some point soon I will make an acquisition. And I'm sure when I make an acquisition, I will make mistakes, because I don't necessarily have a map to absolutely succeed without failure.
There are no guarantees in that work.
Absolutely. But I know absolutely the patterns of what goes wrong.
Right.
And where it goes wrong.
Okay.
Right. Because I've seen those things happen.
What, post acquisition?
Yeah, post, sometimes a bit before, what could be done before to prevent it. And I think that I just thought, you know what, I really need to get this message out there. I need to, there's going to be a lot of acquisitions, and I want them to be good acquisitions.
Right.
And most acquisitions fail to deliver on what you want them to deliver on.
Yeah.
And I don't want that to be the narrative. And so if I can get a book out there, to publish that, make that well known, then that's only a good thing.
And is the score framework in there, or is there different?
Yeah, so the score framework's in there. There is a framework around the book, but the score framework's the main thing, right? And that is because it's the valuation piece. That is basically the culmination of my 150 acquisitions.
Which is an insane amount.
Yeah. It is.
Like that should be a career-ending number, let alone a career-starting number.
Yeah.
You're going to hit 500 if you carry on at this run rate.
Yeah, we'll have to wait.
Is that the ambition? Would you like that? Would you like to be sitting there, in 10 or 15 years' time going, I've helped clients do 500 deals?
No, I think in 10 or 15 years' time, I'd like to say I've done 100 deals.
Oh, wow. Okay.
I think that's where I'd like to get to. So, my next stage...
Is that the big move for you next? Is that the next big move, do you think?
Yeah, so I think in some way, shape or form, I want to sort of be a part of a new private equity fund that works on buying small businesses and getting them up and supporting them and then taking them forward. So I think that's the next journey. Yeah, we just need to think about how we find those deals. But yeah.
But that's okay.
Yeah.
And it's like, as we were talking about yesterday, wasn't it? In F12, it's like most of the challenges that we have in a business is a who question, not a how question. The how question can be answered by AI 9 times out of 10.
Yes.
The who question, though, is a better question because somebody either has the network, has the contacts. I'm just thinking of somebody now I can plug you into who might be able to help with that. And it's like, oh, great. And I think there's a lot of power in speaking things into existence.
Yeah.
When you start saying, well, this is where I want to go next. I want to get 7 figures and then I want to start thinking about a fund. It's like, great. Well, that could be a 5-year journey, right? Before you're ready to do that. But if you start talking about it, then people will be, oh, that's interesting. I didn't know you were trying to do that. And then they start looking at it. It's the same when I started saying, well, actually, I've become an angel investor in sort of SaaS companies or tech companies, but specific niches that help entrepreneurs scale. That's the kind of thing I'm passionate about. You got to absolutely help, entrepreneurs scale. But then it became, suddenly things started coming to me because people go, oh, I didn't know you did that. And I was like, well, yeah, because I haven't really talked about it. And I think sometimes you have to project it into the future in order to attract the connections that you want as well, right?
Yeah, absolutely.
So you've done lots. First of all, is there a question that I haven't asked you about acquisitions or exiting that I should have asked you?
No, none that
Is there anything I've missed? Just want to make sure.
Nothing that jumps to mind.
Okay.
No.
So let's kind of round out with this. Obviously, we'll drop a link to where people can grab a copy of the book or find out about the book. We'll drop that below in the podcast below, which is awesome. But you've been around me for 3 or 4 years now. What's your definition of a grown-up business?
I think a grown-up business is a business that gives the owner what they're looking for. And I think that it's about being... Yeah, it's about giving the owner what they're looking for. So if that's flexibility, if that's finance, that's flexibility and finance. And if that's a performance business that generates a large asset value that creates incredible value in the world, then that's what a grown-up business is.
Yep.
I think yes, I think it's absolutely dependent on the business owner and their ambition. But if you don't know what your ambition is, you can't have a grown-up business.
This is true. Listen, it's been an absolute really enlightening conversation. Gone into some areas I wasn't expecting as well. So if you are listening to this podcast, you want to find out how do you save that £4,000 a month tax, check out Saul's tax the scorecard, which we'll link below this. Highly recommend you follow him on LinkedIn and connect with him on LinkedIn. He's always sharing amazing value on that. And yeah, make sure you grab a copy of his brand new book, which is called
Finding Gold.
So just before we jump out, I promised earlier that we'd talk about a marketing lesson that you got from using your scorecard around the tax saving.
Yes.
So you set up a scorecard to help people work out how much tax they might be able to save.
Yeah.
Right. Share the story about how you had to downplay the results.
Okay, so that was really interesting. So I started it with save £40,000 a year in tax.
Right.
That was sort of the headline, and all the ads were save £40,000 a year. And what we found was that no one was clicking the ads. It wasn't going through, and even the people that clicked the ads, they weren't taking the scorecard. So we looked through, we tested a whole load of things, and then the agency that I was working with, they said, I reckon it might just be not believable.
Yeah.
Yeah. So I said, oh really? They said, yeah. So let's change it, and they made it save £10,000 a year in tax, and increase was just through the chart.
It's believability, right? Yeah,
and then I think they settled on 12. I think that's where they settled.
12 is a magic number, as we know. It's a very powerful number. Do you know what? I'm big getting into numerology and stuff like that. The number 12 means to feel supported.
Really?
Do you know, which I didn't know when I created the F12 Mastermind. But the number 12, 12 for 12 months was part of the reason we did that. But the F12 Mastermind, actually, the number 12 means to feel supported and to feel like you are guided and supported, which is just interesting.
That is very interesting, actually. Yeah.
So people resonated. So the number 12 converted better than number 40.
Yeah, which honestly, you know what is really interesting? I thought that was really quite funny. we just had to say that it was less. But yeah, I suppose it taught me two things. Number one, the value of actually sometimes you need to undersell yourself,
right,
to make it more attainable for people.
Yeah.
And if you make it look like you're too good, then people might think that you're out of their league a little bit.
Oh, that's interesting. Yeah.
So that was also quite an interesting takeaway. And then the other thing was that sometimes it's much better if you can undersell. I think Alex Hormozy mentions this. Is that if once you've made a promise and the promise is converting, you want to get the promise as low as possible to still have conversions, because then what happens is, instead of that promise becoming what gets you through the door, that now becomes added value post-sale.
You're nice.
And I have noticed that, actually, when people come in and they say, oh yeah, well, we can probably save you 12 grand. And then we look at them and we've managed to book a call. And on the call I say, yeah, we could probably save you 25. And then they're really excited. Yeah. And then we do the work and they say 45 or 40 or whatever. And they're like, this is incredible. and from my point of view, I knew that at the beginning that was likely. But now I'm seeing it.
Awesome.
Yeah.
Great tip. Brilliant stuff.
Cool.
This is Saul. Thanks ever so much for being on the Grown Up Podcast today. If you're not subscribed, make sure you subscribe, follow, like, and give us some feedback. What did you take away? What did you like most about this conversation? What's been really helpful? We'll see you on the next show. Take care. That concludes this episode of the Grown Up Business Podcast. I hope that got you fired up and ready to grow. The key thing, though, is to remember you get paid on what you get done. So write down the top 3 actions from the show and make sure that you implement those in the next 72 hours. Hey, and while you're at it, make sure you click the links and the resources below this episode to claim free growth resources to help you build the business you desire and deserve. I'll see you on the next episode.